indeed rock solid. Okay? These 11 dividend-paying positions will continue to profit for the next 12 months, not just during the short term. First position I want to give you is Enterprise Products Partners, symbol EPD. It's in the energy sector, has a market cap of $52 billion, currently pays a yield of 7%. Now, this is a position that operates more than 49,000 miles of pipeline, 260 million barrels of crude oil storage, and another 14 billion cubic feet of natural gas storage. Now, currently, Enterprise Products, once again, that symbol is EPD, offers a great yield of 7% and has a strong track record of raising distributions over time. And it's the consistent and growing payout that is the hallmark of a good MLP investment. As you know, EPD is a master limited partnership. Okay? Next up, Ladder Capital, LADR. It is a real estate investment trust. Market cap of $2 billion. Current dividend yield of 9.2%. Okay, now, Ladder Capital trades under the symbol LADR. Is not your typical real estate investment trust. Unlike other stocks that are owning shopping malls or office parks, LADR doesn't own physical properties. Instead, it invests as a third party in these large real estate holdings, either through lending, equity investments, or other financing. You see, this makes Ladder Capital, symbol LADR, more of a financial stock than a real estate play, since its stock is tied to the performance of its underlying investments in properties. But the difference is that while banks can operate with a bit more flexibility, the designation as a real estate investment trust demands that the firm delivers 90% of its taxable income back to shareholders. And that is a mandate for big dividends. And with LADR being a pass-through for shareholders who want to share in the fruits of its investments, this is a match made in heaven. Now, I want you to note this though. This is a great cyclical dividend play for the next few years as a result of rising rents and property values will tend to present themselves in 2018. Ladder Capital Corp, symbol LADR. Next wonderful dividend paying position is ABBV, symbol ABBV. It's in the healthcare sector. It has a market cap of $153 billion, a dividend yield of 3%. Now, AbbVie was spun off of the big pharmaceutical company Abbott Laboratories back in 2013. And it is the drug-focused arm of the previous company. Now, it is the home to current blockbusters including psoriasis treatment Humira, as well as a research-driven drug maker looking for the next generation of big-name cures. Now, analysts are projecting revenue growth at ABBV, which is AbbVie's trading symbol, of almost 10% this year and next year, and a profit expansion of 15% or better both years thanks to a strong pharmaceutical portfolio. Family members, AbbVie, 3% yield, $153 billion market cap, a spinoff from Abbott Laboratories to get you paid consistently via dividends and our dividend option trifecta effect strategy. Next position is the Southern Company, symbol SO. It's in the utility sector. Market cap of $51 billion, yield of 4.5%. Now, the Southern Company's symbol SO is one of the largest utilities in the United States. Remember, when you invest in what society needs, like utilities, you get paid all of the time. When you invest in what society wants, you get paid some of the time. I repeat, Southern Company, symbol SO, is one of the largest utilities in the United States, serving 19 states through various subsidiaries. Now, while its oldest core holdings, including Alabama Power and Georgia Power, are electrical utilities, the company's Southern Company Gas operates a massive natural gas distribution business from Maryland to Florida, and its Southern Telecom is a play on fiber optics in the Southeast as well. On top of that, the Southern Company has raised dividend payouts at least once each year since 2001, even as it continues to expand aggressively into other businesses and geographies. The Southern Company, symbol PSO. Next rock solid dividend payer I want to give you is Phillips 66 Partners, trades under the symbol PSXP. That's Phillips 66 Partners, trading under the symbol PSXP. It's in the energy sector, market cap of $5 billion, current dividend yield of 5.8%. Now, many of the most successful MLPs, talking about master limited partnerships, have been created by large energy companies that want the benefit from the unique structure of this kind of business. It's often a win-win for both the primary stock, that is the general partner, as well as for the new partnership that has been created. And that's exactly the case with Phillips 66 Partners, symbol PSXP, and its corporate parent, ConocoPhillips, symbol COP. Now, this company, we're talking about PSXP, was spun off in 2013. And Phillips 66 Partners consists of pipelines, terminals, and other midstream assets that help power the broader ConocoPhillips business. Very smart indeed. Now, listen to this. Phillips 66 Partners, we're talking about PSXP, has raised its dividend for 16 consecutive quarters since entering public markets and is clearly committed to delivering consistent income to its shareholders. Phillips 66 Partners, symbol PSXP. Next, Medical Properties Trust, symbol MPW. It is a real estate investment trust, market cap of $5 billion, dividend yield of 7%. Now listen to me closely. This is a wonderful REIT that has gotten the Asset Wealth Street family paid consistently. Now, Medical Properties Trust, once again that symbol is MPW, is a fast-growing real estate investment trust, seeing brisk expansions of its funds from operations. The most important measure, by the way, that we can get from this special class of tax shelter companies. That reliable and growing flow of cash also helps fuel reliable and growing dividends to the tune of 7% currently. But it's not just the income potential that's worth a look here, family members and listeners alike. No, you see, aging baby boomers are increasing demand for care in the United States. Inflationary trends guarantee price power in the sector. And even in an economy downturn, you'll see Americans cut back on everything but their health care. Now, MPW is well positioned to capitalize on this trend thanks to its ownership of community hospitals and acute care centers. And a recent acquisition of 11 more facilities will certainly boost its numbers in the years ahead. Medical Properties Trust, market cap $5 billion, dividend yield 7%, symbol MPW. Now this next position, every time I give it, I tell our Wealth Astute members, put your emotions to the side. And I'm going to tell you what this company is doing to reinvent itself. Ultra, symbol MO. The sector is in consumer staples. Market cap, $129 billion. Dividend yield, 3.9%. Now listen to me closely, everybody. Ultra Group, symbol MO, may strike some as a no-growth company without much upside. However, this particular position is not just a dividend stock. Consider that over the past 5 years, it has actually outperformed the S&P 500 in share price performance alone, thanks to aggressive buybacks and shrewd management of profitability. Now, Ultra Group, as you know, is in the tobacco business. They sell cigarettes amongst other tobacco products. Put your emotions to the side. Now, MO stock is a go-to for dividend investors after 48 consecutive years of increasing its payouts. Those increases aren't a penny here and a penny there either, as evidenced most recently with an 8% bump in 2017 from 61 cents to 66 cents. Now yes, traditional tobacco product level of long-term stability. And let me tell you something else they're doing very intelligently, and I discussed this with the Wealth Institute several weeks ago. They are buying up marijuana farms. As marijuana becomes legal in more and more states, and Canada has announced that they plan on legalizing marijuana across the whole country, Ultra has very cleverly gone in and they're buying up marijuana farms. They'll be bringing, marijuana. They'll be bringing joints to a convenience store to see you soon if you live in a legalized state for marijuana. Ultra, symbol MO. Next company I want to give you is Cisco, symbol CSCO. Sector is technology. Market cap, $186 billion. Yield, 3.1%. Now, when investors look for reliable dividend stocks, often they overlook the tech sector. That's in part because even tech companies like Apple that pay some kind of dividend still offer less than the 10-year treasuries. Or on the flip side, because many tech stocks that do yield a decent amount don't have much to offer investors beyond the dividends. But Cisco Systems, symbol CSCO, stands apart. Not only does the IT giant currently offer an attractive dividend with payouts that have jumped from 6 cents in 2011 to 29 cents a quarter at present, it also has a good growth story to tell after an impressive earnings report before Thanksgiving. Not only did it beat on earnings and boost its outlook, but the company showed Wall Street it is effectively transitioning away from networking hardware and into cloud business solutions that are the norm in 2017. Shares are currently up about 20% in the last 3 months as a result of this. Now, these structural improvements at Cisco bode well for 2018 and beyond. And given Cisco's commitment to increase dividends and deep pockets with some $72 billion in cash and investments in banks, you can be certain this company will keep rewarding shareholders for the next decade to come. Cisco, symbol CSCO. And this next particular position I want to give you is Dominion Energy. Trades under the symbol D. It is in the utility sector. Market cap of $52 billion, yield of 3.7%. Now, Dominion Energy is a safe play for a series and host of reasons. But chief among them are the facts that it is a low-risk utility stock with reliable operations and a significant yield. Now, Dominion generates electricity mainly in the mid-Atlantic regions of the United States, from North Carolina to Pennsylvania, and distributes natural gas across a wide swath of America's western portion of the United States. Now, the consistent cash flow from these operations has fueled consistent dividend payouts for almost 90 years, beloved, and has allowed Dominion, symbol D, to grow payouts substantially over time. Distributions were 39.5 cents per quarter at the end of 2008, and now they are 77 cents, and that's an increase of about 95% in about 9 years. The icing on the cake is that Dominion is one of the most adaptable and diversified utilities in all of the United States, with numerous nuclear and renewable power generation facilities in its portfolio. This isn't just good as a hedge against the long-term decline of fossil fuels, but also a bridge to new businesses. One recent headline that should really pique investors' interest is a recent contract to provide renewable energy to a Facebook data center in Virginia. You see, that kind of willingness, family members and listeners alike, to meet big corporations where they live is a strong sign that Dominion, symbol D, is forward-thinking and isn't just sitting back collecting monthly checks from customers. And the next position I want to give you is Merck, symbol MRK. Now notice, I'm giving you positions that are in sectors that provide what society needs: utilities, healthcare, and the like. Okay? Medical REITs. Stay with me. Now, Merck is in the healthcare sector. Market cap of $151 billion, yield of 3.4%. Now, Merck, symbol MRK, well, it continues to see growth as its drugs look to fight common American health concerns and conditions. Its blockbuster's diabetes drug, Januva, which helps lower blood sugar, accounts for some $4 billion in annual sales. And its Zeta cholesterol medication racks up over $2 billion in annual sales. And it's not done either. No. Merck is a big boy. It has a strong product pipeline that includes cancer drug Keytruda, and the pipeline could open avenues to much larger revenues after a very nice showing so far in 2017. You see, the marriage of the so-called maintenance drugs to provide regular revenue will fuel dividends now, and new drugs could help continue dividend growth going forward. With one of the biggest and most stable brands in medicine, this healthcare stock is a great long-term play for you, me, we, the ASK THE WIZ Wealth Institute family as dividend traders, dividend investors. The healthcare company has paid consistent dividends since 1970 and is indeed a rock-solid position for the coming year, 2018. And the last position I want to give you is one that will get you P.A.I.D. I've just given you 11 set them and forget them dividend positions. You pick and choose the ones that best meet the goals and objectives of your portfolio. This last position is Procter & Gamble, symbol PG. Sector, consumer staples. Market cap, $125 billion. Yield, 3.1%. Now, you couldn't have a list of safe haven investments without Procter & Gamble, old PG, one of the most reliable consumer names on the planet. Powered by amazing brands from Dawn dishwashing soap to Gillette shaving products to Crest toothpaste, P&G has its fingerprints all over the typical household. And best of all, for low-risk investors, these products will keep selling no matter what the macro picture in the economy is like, because people still need to what? Clean their bodies and their kitchens regardless of where the S&P is headed. It also, talking about PG, has a consistent commitment to dividends, increasing its payouts for the last 60 years consecutively. Let me repeat this. Procter & Gamble has a consistent commitment to dividends by virtue of and demonstrating that by increasing its dividend for the last 60 consecutive years. And these increases in dividend have been generous. Okay? Distributions have roughly doubled in the last decade, meaning P&G dividend hikes are in the ballpark of 10% each year. Yes, shares have been range-bound for a few years now, but a recent proxy fight with activist investor Nelson Peltz, has shaken the company awake. And even if the tally in the voting has been disrupted by P&G, the message from its investors is crystal clear. Pay more attention to the bottom line and to deliver real shareholder value. That should usher in some important changes that help the stock remain dominant as we enter into 2018. Multiple positions